Today, I have an exciting topic to cover that could help you achieve long-term financial success: the three-fund portfolio. If you are new to investing or looking for a simple yet effective strategy, this video is for you. Stick around as I guide you through my non-traditional three-fund portfolio. Hey everyone, I appreciate every click of this video, so thank you so much for doing so. If you are new to this channel, my name is Brad, and my goal is to be as transparent as possible with my finances while also helping you increase your net worth. If this is the type of content that you are interested in, now would be a good time to subscribe. Getting back to our topic, before we dive into the details, let's first understand what a three-fund portfolio is all about. A three-fund portfolio is an investment strategy that consists of three primary asset classes: stocks, bonds, and international equities. The goal is to create a diversified and balanced portfolio that provides exposure to various market sectors while minimizing risk. Well, at least that's what the traditional three-fund portfolio is. My personal strategy is a little bit more aggressive. I personally am more interested in fast growth and future dividends, so I'm willing to take more risks than the average investor. A traditional three-fund portfolio will be made up of 50% stocks, 40% bonds, and 10% international equities. My personal three-fund portfolio is going to be 90% stocks and 10% bonds, which eliminates the international equities question entirely. Even with that being said, the makeup of my three-fund portfolio is very simple. 50% goes into a total stock market index fund, 40% goes into a dividend-producing index fund, and 10% goes into a bond fund. Before we get into what these actually are, I want to say all of my investing is automatic. I simply have my Robinhood account set to invest in these funds weekly as a way to dollar cost average. If you don't know what dollar cost averaging is, it's just investing small amounts weekly or monthly to mitigate the risk of the ups and downs of the market. I have to say as a disclaimer, this is not investment advice. This is just what I personally do. So let's hop right into what I actually invest in. As I said previously, 50% of my investment goes into a total stock market index fund. And if you know anything about index funds, you know that Vanguard usually offers the lowest fees. So I specifically invest in VTI, which just stands for Vanguard Total Stock Market Index Fund. Obviously, this fund does not invest in every single stock in the world, but it currently has almost 4,000 holdings. So essentially, you are being massively diversified just by owning this stock. Here's another interesting thing about Vanguard. There are other companies that will pay influencers to push their funds, but Vanguard's fees are so cheap, they do not really do any marketing. The fees for VTI are 0.03%, so if you had $1 million in this particular fund, you would only be paying $300 per year. So essentially, this fund markets itself. Also, in the past 10 years, VTI has increased by almost 200%. My only hang up with VTI is its dividend yield of 1.53%, which we will circle back to later. Now let's talk about the next stock in my three-fund portfolio. This time, it's another Vanguard fund called VYM, which stands for Vanguard High Dividend Yield ETF. 40% of my investment goes into this fund. Now, some people might complain that there's going to be overlap between VTI and VYM. Of course, that is correct because VTI is the total stock market, while VYM focuses on companies that pay high dividends. VYM only holds 469 companies, which is obviously lower than VTI. But again, we are only focused on high dividend yields here. One thing that might hang people up with VYM is that its fees are 0.06% per year. That is double the fees of VTI, but I could give them a pass since it's still considerably cheaper compared to other high dividend yield ETFs. And it helps that its most recent dividend yield is 3.14%. Keep in mind that with massive funds like VTI and VYM, these dividend yields are going to constantly be changing. I have seen VYM under 2%, but as high as 4.5%. This is just how things are going to be, and you'll have to get comfortable with that if you're going to invest. The third fund that I invest in, which accounts for 10% of my strategy, is BND. It may come to absolutely no surprise to you that this is another Vanguard fund. It is the Vanguard Total Bond Market ETF. BND holds nearly 10,000 individual bonds. You might be starting to see a trend here. When you invest in funds over individual stocks, your risk is going to be spread out so far that you won't notice anything that goes wrong with an individual company within the fund. With only a 0.03% expense, this fund is very affordable. But what you will notice about this fund, or with any bond fund really, is that you're not going to see spectacular gains. Bonds are more for security and consistency. One good thing about BND is that the dividend yield is currently at 2.76%, so it might pay to hang on to it. Hey, real quick, thanks so much for watching up to this point in the video. I appreciate you all, and I wanted to encourage you to subscribe to this channel if this is the type of content that you are interested in. Don't forget to head over to my channel after this video ends and check out my latest monthly net worth update. Also, please like this video, share this video, and comment to get this video and my channel in favor of the YouTube algorithm. It helps way more than you think. As you can see, I am a big fan of Vanguard and their low-cost index funds. I am not being paid to talk about these index funds, and I think that their performance and fees speak for themselves. Before you think about investing in index funds, make sure that you understand expense ratios and historical performance. Do the research yourself and find out which funds you think will be best suited for your situation. Getting back to my situations, my desire is to own mostly rapidly growing funds that produce dividends. But as you saw, each stock produces a different dividend yield, which means that my overall dividend yield is going to be different from each individual stock. After doing some calculations, assuming that I'm keeping a consistent 50% of my portfolio in VTI, 40% in VYM, and 10% in BND, my portfolio will be shooting me a yearly dividend payment of about 2.3%. This means that for every million I have in my portfolio, I will get around $23,000 per year. Since half of my portfolio is in the fund with the lowest paying dividends, it really brings down the average of all three. I realize that 2.3% per year is a big letdown to some people. But consider this, in 2021, VTI rose over 25%, meaning that if you had $1 million in VTI at the beginning of the year, you would have $1,250,000 at the end of the year. Usually you will find that stocks with higher dividends don't appreciate as fast as stocks with lower dividends. This isn't some rule that I firmly stand on, but it is just something that I have observed since I started investing. So now you know about my 3-fund portfolio, and I am interested to hear what you all have to say about it. Do you think this is a good strategy? Or are you more interested in the traditional route? I make these videos to get the conversation started on what it takes to build your net worth and invest properly. And I love connecting with you all and seeing what you have to say. That's it for now. Until next time, keep at it.